But now I'm very pleased to introduce Charles Plosser, the President and Chief Executive Officer of the Federal Reserve Bank of Philadelphia from 2006 until the end of last year. Before joining the Fed, Charles was a professor of economics and public policy and director of the Bradley Policy Research Center at the University of Rochester. At the University of Rochester, Charles and Karl were colleagues, and Charles joined the faculty in 1978. I guess this is right. And Charles followed Karl, who founded the Journal of Monetary Economics, just mentioned that at the beginning as editor of that journal. And Charles is one of the few people who know central banking from both sides, the shadow open market committee and the real Federal Open Market Committee. And as you can see, Charles and Karl's career paths crossed time and again. And therefore, it's really our great pleasure that I can give you the floor. And Charles will talk about the personal remembrance to Karl Brunner. Thank you very much. The floor is yours.
Thank you very much, Thomas, for that kind introduction. I'm actually very delighted to be here today. It's actually a privilege and to celebrate Karl Brunner's 100th anniversary and birthday. I don't know. It's pretty special, and it's an honor, in particular, though, to be asked to speak at this event. And I want to thank Thomas and the organizers for inviting me to do this, and I just feel deeply moved and pleased to have this opportunity. Now, of course, nobody knows Karl's intellectual contributions and knows Karl like Alan Meltzer. None of us can match his ties with Alan. And he gave us a wonderful review this morning of Alan, his work, and insights into his scholarly contributions in particular, but also the friendship he's had. And those contributions spanned not just economics and economic theory. It spanned the intersection of economics and political science, sociology, and of course the philosophy of science that Karl was deeply interested in. It was truly an amazing career of what I consider to be a powerful intellect and a truly committed scholar. Rather than review his scholarly work, I want to talk a little bit about my personal relationship with Karl, how Karl influenced and shaped my academic career as an economist, and then also talk a little bit about how Karl's views intersected with my time as a policymaker at the Fed. I want to use that platform, particularly about how he influenced my academic career, to illustrate the important commitment that Karl had in developing young scholars, committed to developing economists and scholars that could lead in the future, lead their profession in the future. On the policy side, more than I think any other academics of his stature, or certainly most of them, Karl really did have a deep interest in policy. And Alan made this clear in his remarks. Now, one important demonstration of that interest was the creation of the Shadow Open Market Committee. Karl and Alan created the SOMC, Shadow, in 1971. And it was intended as a means to bring informed policy insights out of the academic environment and make them accessible to the press, to the general public. And that committee still operates to this day. I had the privilege of serving on that committee for about 15 years, was co-chair of that committee with Anna Schwartz for the last 5 before I left and went to the Fed. And what a privilege it was to do that. Michael Bordeaux here probably and Alan both know Anna much better than I did, but that 5 years as co-chair with Anna Schwartz was truly an amazing experience for me. Now, I first met Karl in October of 1975. It was hardly a memorable meeting. In fact, he probably wouldn't even remember it. I was a PhD student at the University of Chicago, and I was giving a paper at the University of Rochester at an NBER-NSF conference at Rochester on Bayesian inference in econometrics. Exciting topic. I was a paper that was being co-authored with Arnold Zellner, a econometrician at the University of Chicago. And it was on the subject of unit roots, Bayesian inference in unit roots. And if you don't know what that is, don't worry about it. The conversation with Karl was fairly brief. Now, I didn't know Karl very well. I'd never really met him before. And I was surprised at his interest in econometrics. I didn't know he had an interest in econometrics at the time. It wasn't until I got to Rochester a few years later that I realized that he had an interest in econometrics. He was an econometrics chair, was his professorship here in Bern at the time, and he had written a book on econometrics. So I lived and learned. And so I didn't learn that until much later. By the way, the paper I'd written with Arnold Zellner on Bayesian inference in unit roots was never published. It died a quiet death. However, it was a precursor to another project I was beginning to work on at the time with Charles Nelson on trends in random walks in macroeconomic time series. That paper that eventually evolved was published by Karl in the Journal of Monetary Economics in 1982. Little side story, it was turned down by the JPE, and Jacob Frankel, who was the editor at the time, didn't understand the paper. That was obviously our fault. But he turned it down, and Karl said, "This is crazy. This paper needs to be out, and it needs to be out now." And he published it. I guess that's one way to get your article in the journal. The next time I met Karl was actually in 1978. It was at Stanford. I was a relatively young assistant professor at the Stanford Business School at the time. And Karl, Alan, and Robert Barrow were visiting the Hoover Institute. I don't know whether Alan remembers this period. And I had been given an offer to move from Stanford to Rochester. People in California looked at me, "Are you crazy?" But I did it. And Karl and Robert Barrow became an informal recruiting team to try to get me to come to Rochester. Barrow had been a professor of mine at the University of Chicago before I graduated, and so they became the recruiting team. Needless to say, I accepted the offer to go to Rochester, and for the next 11 years, until his death, I had the privilege of being Karl's colleague. Interestingly enough, Bob King arrived in Rochester at the same time as a new young assistant professor from Brown. Bob and I became very good friends, collaborating on many papers for the next 15 years or so. Now, Bob and I spent many hours with Karl, and together and separately. Karl was generous with his time and always had time to talk about a problem, a paper, your paper, his paper, somebody else's paper. He always had time to talk about it. And you'd go into Karl and you would maybe schedule it for a 30-minute or a 45 or an hour meeting. And oftentimes, 2.5 hours later, you could come up for air. And not only that, not only the meetings not only they last a long time, but he would also set a meeting. We need to come back and talk about this tomorrow or next week or something. That often happened when he didn't think you had it right yet. And there were a lot of those as well. So in this early period, I was already working on ideas related to what would later be called real business cycles. John Long and I had many conversations with Karl about real business cycles. Karl was deeply interested, but he was very much a skeptic, for some of the reasons you've already heard this morning, but I'll touch on those. He really liked the micro foundations of the way we were approaching economics and macroeconomics with micro foundations. He really enjoyed the fact that it was a disaggregated model. It was a multi-sector model as opposed to a one-sector model like most macroeconomics was. He wasn't too enamored with the fact that there was no money in the model. I mean, he was very supportive, but he said, "I just don't think you're going to get very far until you get money in this thing." And I argued with him, no, you didn't argue with Karl. Well, you could, but it wasn't always fruitful. I argued with Karl a lot. I said, you know, Karl, we really should understand growth and dynamics in a perfectly working economy before we start introducing a lot of complications. Because at the end of the day, surely there are real shocks that occur in the world that lead to fluctuations in real economic outcomes, and particularly transitory outcomes. So we're bound to have dynamics without money, and if we ultimately want to understand the contribution of money to the dynamics of the business cycle, we need to be able to have a model that builds up from first principles where you could understand both, and then try to determine empirically whether or not how much of the contributions were coming from these real shocks and how much might be coming from nominal shocks of some kind. So Karl had these reservations, but despite his reservations, he was always engaged with us, arguing, challenging, pushing, and he enjoyed that. Now, of course, Karl was not the only one who was dubious of real business cycle models in those days. I remember a seminar I gave in about 1980, 81 at MIT, and Franco Modigliani came up to me after the seminar, and he said, it's magic. I don't believe it. I don't believe in magic, and that's what this is. Well, so Karl wasn't alone in being suspicious of real business cycle models. But one of the direct consequences of those conversations with Karl about money was a paper that Bob and I then did, and then we started long before Long and Plosser was finished, or Kittleman and Prescott was finished, or any of those. It was a working paper, first drafted in early 1981, on money in real business cycles. Once again, Karl and Alan expressed great reluctance with this model. They did not agree with it in general, parts of it, but not all of it. But my point is that Karl invited Bob and me, two young assistant professors, to present at the Constance Seminar on Monetary Theory and Monetary Policy. And that was in June of 1981. It was a great opportunity for us. Karl didn't agree with the paper. At the end of the day, I don't think Alan was our discussant, but I can remember this day in Constance with Alan lecturing Bob and I about what was wrong with our paper. But Karl gave us the opportunity. And it was a great opportunity for us. That paper eventually appeared in the American Economic Review in 1986. But Karl gave us the opportunity, as two young assistant professors, to come to Europe and present his paper. I want to mention one other a research project that was intimately related with Karl and my time with him. And it was the title of the paper that Bob and I wrote was Money is the Mechanism of Exchange. You've heard Alan mention earlier that Karl and I both had a long interest in understanding the micro foundations of money, and in particular the importance of uncertainty in understanding the role and foundations of money in our society. The paper that Bob and I wrote stressed the existence of money as a means of solving an asymmetric information problem and other sorts of uncertainty. Karl is probably the most enthusiastic paper I wrote that Karl was interested in. He spent many hours with us on that paper, encouraged us. And as a young assistant professor, I received summer support, which was always a desperate thing you were struggling with as an academic, from Karl and his center, the Center for Research, Government Policy, and Business, to work on that paper as well as many others. Now, I mention these personal examples not because they help illustrate, I think vividly, Karl's interest and commitment to young economists and scholars. It was very important to him. And that commitment not only was my own experience illustrative of that, it showed itself up in many other ways. For example, Karl was truly passionate about his responsibilities as a journal editor. And as you've already heard, he was the founder of two prestigious refereeing journals in economics, the Journal of Money, Credit, and Banking, of course, and the Journal of Monetary Economics. I think I can speak for Bob as well when I say that Karl would lecture to us about the responsibilities of journal editors. And when Bob and I became editors of the Journal of Monetary Economics, Karl spent many hours telling us what he thought about journals. It wasn't just the journal editor was responsible for generating a high-quality referee report for authors, but it was especially important when it came to junior faculty. Junior faculty who may not have colleagues at the institution they're at. Junior faculty who were new to the field and writing challenging topics or maybe new topics. Karl said, your responsibility as an editor is not just to accept or reject the paper. Okay? Our task was to improve their scholarship and improve their writing, of all things. He wanted to encourage and create opportunities for young scholars and believed that the refereeing process was an important channel for doing so. Now, Karl also wanted to encourage young scholars to take an interest in policy, policy-related research. This was not easy. Incentives for young economists in the academic environment in economics to invest their time in policy-related research were very weak. There was not much motivation for that. But with the creation of the Carnegie-Rochester Conference Series on Public Policy that you heard about earlier, Karl and Alan had another vehicle for introducing young scholars to quality research in public policy issues. So not only did they make the point to invite young academics to the conferences, but they invited them to write papers at the conference. They invited them to be discussants of more senior people's papers. The proceedings were published in the Journal of Monetary Economics, and including many senior, well-known academic economists along with them, and that made the conference and the conference series more attractive to junior scholars as an outlet for their work. It was really important for helping junior scholars get interested in public policy issues. Now, not surprisingly, Karl's support for younger scholars extended beyond the United States, extended to Europe as well. With his position at the University of Bern, he created opportunities for many Swiss graduate students to travel to the US and spend some time at the University of Rochester. Actually, I seem to recall that through most of the 1980s, there were one or two Swiss students visiting for part of a year, at the University of Rochester almost every year. That list of visitors included people such as Walter Wasserfallen, Bruno Gehrig, and others who may be even here today. Some came and earned their degrees, their PhDs, including Claudio Loderer and Tom Lees. Others came and pursued an MBA. So his interest in bringing young scholars in and teaching them, giving them opportunities, was an extraordinary, important part, I think, of Karl's legacy. And it affected me very deeply, and I think it's one of the things that I think is important to appreciate. Let me shift gears a little bit now and talk about monetary policy. I joined the Federal Reserve in 2006 as president of the Federal Reserve Bank of Philadelphia. Little did I know what I was in for. All hell broke loose within about a year, and I had no idea what to expect, I did not expect what ended up happening. Now, for Karl, policy and theory were intimately intertwined. Yet for him, conducting policy was never as simple as following the prescriptions of some specific model. As he often noted, all models are wrong, but you need to know and understand their strengths and weaknesses if you're going to make policy. Now, many of the shortfalls in the conduct of monetary policy that Karl stressed during his career, I don't think have been adequately addressed even today. During my time at the Federal Reserve, I found myself reflecting on some of Karl's messages as monetary policy unfolded in those tumultuous times. So I want to try to focus on two themes that I think loomed especially large, that were woven through much of Karl's policy critiques, and some of which have actually been talked about already today. That is uncertainty, and the other is the importance of institutions that hardly ever appears in our models. Now, one persistent theme, as you've already heard today, of Karl and Alan's work was related to policy, or the way policy was uncertainty. Now, they stressed a number of different kinds of uncertainty that were relevant. But I'm going to simplify it, and I'm going to say, let's talk about the uncertainty about the economic forecast, the uncertainty about the effects of policy, and the uncertainty about how to measure the thrust of policy. Each of these aspects of uncertainty loomed very large for the FOMC during the past 10 years, and I would argue still loom large today. During the financial crisis, it was fairly clear there was a great deal of uncertainty regarding the economic forecast. We didn't have a clue what was going on at some point, much less what was going to happen. By the way, as an aside, there are many people, mostly in government and public policy, who think we know what happened during the financial crisis and that we understand it and we've got the regulations in place to fix it. I don't believe that for a minute. All you have to do is realize that the economics profession today is still writing dozens and dozens of papers every year on the Great Depression. And our view of the Great Depression has evolved immensely over the last decade even. Many papers about the consequence of policies that we thought were good are now being viewed maybe not so good. Policies that we thought were bad maybe turned out to be not as bad as we thought. So we have a lot to learn, and we have a lot to learn about the recent crisis as well. So during the financial crisis, it's fairly clear that there was a great deal of uncertainty, as I said, about the economic forecast. Our economic models were not well designed to deal with such episodes, particularly the early part of the crisis. And at least in the US, the data or experiences were fairly limited. Even after the crisis, the financial crisis ended and the recession moved on, forecasting the recovery from the recession was fraught with challenges. The FOMC and staff forecasts were consistently overestimating GDP growth and underestimating the pace of improvement in the unemployment rate. Every year. So our economic models were not designed well to deal with this episode. Uncertainty regarding the effects of policy was also unusually large. Now, in part, the uncertainty about the effects of policy arose because unconventional policies, we reached the zero bound, unconventional policies were adopted after we reached the zero bound. The Fed had little or no experience with large-scale asset purchases. The transmission mechanism was uncertain. There were debates about whether the effect of asset purchases or long-term purchases of long-term assets, did they work through the stock or the flow? But there was uncertainty as to what the effects of changes, even in long-term rates, would be on employment and inflation. We had no experience. We didn't have much data to go from. We were reaching and grabbing for options. On top of all that, there was uncertainty as to what the impact of policies like, quote, forward guidance would be. Now, there was some theory about the importance of forward guidance. And theories are helpful, and we relied on those. But we had no quantitative, empirical evidence about the effects of forward guidance or its effectiveness. In part, the reason for that is that forward guidance hinged critically on how and what the FOMC communicated, how it communicated its intentions, and ultimately on the credibility of its promises. We had no measure of our credibility. We didn't know whether our credibility was high or low, or whether the public believed what we were saying, understood what we were saying, or believed we would follow through. It was a terribly difficult problem on measuring the effectiveness or forecasting the effectiveness of our policies. Uncertainty about how to measure the thrust of monetary policy was another major challenge. The FOMC had to determine what measures, or combinations of measures of money, credit, short-term interest rates, long-term interest rates, were the appropriate measures of the thrust of policy. Were we too easy or were we too tight? It had to contend with how to determine the appropriate scale of asset purchase. Should the purchases be 100 million, 200 million, 300 billion? We didn't have any idea. We had no experience about what the effect would be. Again, was it a stock or flow effect? How did we translate these measures into appropriate measures of our actions if we were trying to achieve certain results? We even tried to do things like, well, 500 billion is equivalent to a 25 basis point cut in interest rates. Maybe. We didn't know how to do that. That wasn't a terribly, we did, but that wasn't a terribly satisfactory way of thinking about what monetary policy ought to be doing. Now, one conclusion Karl reached when you thought about all of this uncertainty was that monetary policymakers should be humble regarding their ability to undertake effective stabilization policy. Yet over the last 10 to 15 years, I would argue, the FOMC for sure, and other central banks most likely, seem to have behaved like increasingly as committed fine-tuners. The number of topics that the Fed considered as to what monetary policy was going to affect, think of different aspects of the labor market. Participation rates, labor force participation rates. I don't know what monetary policy has to do with that. We have no theory, we have no data to explain why we were trying to improve the participation rate. The ratio of temporary employment to permanent employment, another feature of the labor market. Was monetary policy supposed to fix that? Well, we claimed we were trying, even if we couldn't. So, interestingly enough, my interpretation of the last 10 years is that for the previous 30 years, we have been making progress in understanding that monetary policy had limited effects on the real economy, limited effects to fine-tune real outcomes, and now we were deeply enmeshed in fine-tuning real outcomes and desperately trying to engage in stabilization policy and fine-tuning. It seemed that the greater the uncertainty, the more aggressive policymakers tried to engage in fine-tuning. I think Karl would have been dismayed. I mean, maybe that's an understatement. I think he would be dismayed at the hubris shown by central banks and the expectations of the public about what central bankers could actually do in this regard. Now, a related theme was Karl's ability. The related theme of this was that the inability of the FOMC and monetary policymakers to coherently and systematically incorporate and recognize the uncertainty that they actually face. You often hear policymakers talk about risk. That's great. Yet over the last 10 years, the FOMC has often cited risks of various kinds to justify, at least in this recent episode, its reluctance to begin a normalization process. Yet there are other dimensions of risk the Fed is woefully inadequate in communicating to the public or anyone else, or understanding how it affects their own deliberations. Let me take, for example, the SEPs. The SEPs are published by the Fed every quarter. It stands for the Summary of Economic Projections. They just published some yesterday. And while this survey is not technically a forecast, because it is a collection of individual members of the FOMC's projections, and therefore it's really hard to assign formal standard errors to these individual projections, or to the median or the modal projection. But those standard errors are important to help the public understand just how uncertain we are about the future. Now, the staff dutifully reports typical standard errors for more formal econometric models, and they're quite large. And that's actually added into an addendum to the SEPs. But rarely is there any discussion or reporting of these huge bands that accompany these projections. Instead, the FOMC reports charts that have a plot of the range of the forecasts the high and the low, as well as the central tendency, which is sort of a truncated, throughout the three highest, throughout the three lowest, and what's left. Those pictures are often interpreted as some sort of uncertainty about the future. Well, they're not. They're uncertainty about the range of they're about the range of the forecast, not about the probability of various outcomes. There are many other central banks, by the way, who take the lot more sophisticated view and report uncertainty and report what they call fan charts, which actually show standard deviations of forecast. And when you look at those, they are many, many times larger than what we see. So it would help there were also many members of the committee, yours truly included, who have pushed for several years for the Fed to report more uncertainty. I mean, right now, what you get is you get the SEPs, a forecast from the Fed, and the headline of the news the next day is the median forecast fell from 2.5 to 2.3%. Fed slashes forecast. Well, there is absolutely no statistical difference between those two numbers in any meaningful sense, okay? And so we didn't do a good job of communicating what was going on. Now let me turn to the other consistent message about policy, and that is institutions matter. Karl believed, I think, that policymakers should look beyond the models and consider the nature of the institutions in which their policies are being made, both their strengths and weaknesses. He especially thought that understanding the incentives within those institutions that individuals receive was important in understanding not just the decisions in a positive sense, that is, predicting what an institution's policy decision would be, but in also making good decisions. Indeed, policies that ignore institutional incentives within the central bank or in other parts of government could actually be perilous. So I saw this play out in sort of two particular examples I'll give you. First, let me offer a positive way in which institutions matter. My own view is the history and politics strongly support the view that independent central banks are associated with better outcomes than non-independent banks, that is, independent ruled by the treasuries. The governance structure of the Federal Reserve System, whether it be by intent, by accident, or some fortuitous combination of the two, has actually served our economy well, I think, in that it has supported, our governance structure and the institutional structure has supported both and helped preserve independence of the Fed. I think it's very important that we understand that. In particular, the semi-private, non-political structure of the Federal Reserve banks provides an important counterbalance to the more political determined Board of Governors. Presidents, for example, are closer to the public and the business communities than governors. They're thus able to marshal support for independence more effectively in a way the politically appointed governors find more difficult. Thus, in many ways, I would say, the decentralized structure of the governance is an important mechanism for supporting Fed independence. There are many discussions today that seek to undermine that governance structure, to make presidents political appointees, for example, or to do away with the reserve banks altogether. The result of those sorts of changes, and maybe perhaps for some people that's a goal, of making a central bank, it would be making the central bank a much more politicized institution and much less independent. On the other hand, the Fed is incredibly naive sometimes when it comes to institutions it's deal with, particularly Congress. The Fed and the board, more specifically, is often caught off guard by Congress and the administration. It fails to appreciate the political incentives of Congress and feels that it can always win on the merits. This is a particular problem when it's not the merits, but the politics that end up determining the political outcomes. Other times, the Fed chooses to ignore the looming challenges, hoping they will go away. Another form of hubris or just sticking your head in the sand. The Fed refused to take seriously, for example, the fact that many of the actions it undertook, including bailouts, claims that it desired to boost asset prices, credit allocation schemes to support some sectors of the economy relative to others, those actions themselves risked a political backlash that can undermine independence of the institution in the long run. Now, the majority of the FOMC and the board, however, sincerely believed they were doing the right thing with these actions, but they weren't completely considering the ultimate cost. Maybe those were the right actions in the short run. But as you view the proposals for reform in Congress today, the price may prove to be quite high in terms of independence and thus for the economy. This could also be related to another Karl's theme. The FOMC was always focused on the short run, never enough on the longer run. So institutions matter, and making good policy requires understanding those institutions and incentives and those individuals that populate them. It is not as simple as solving the optimal control problem for some economic model. In Karl's view, good policy making was much more complicated. Not only do you have to have your economics right, you also need to understand the institutions within which you're operating. So I'd like to close with a story, true story, about Karl's colleagues at the University of Rochester. In 1983, the economics department of the Graduate School of Management at Rochester put on a musical in Karl's honor. Believe it or not, as I was moving, I discovered this with a few holes in it from 1983. The title of the musical was Karl's Dream. Okay? Now, some of you in the audience know this very well, because some of you were there, and some of you were actually actors in the musical. The actors included Bill Meckling, who was the dean of the business school at the University of Rochester at the time, close friend of Karl's, close friend of Armin Altson's, and Bill Meckling played Paul Volcker. Those of you who know Bill, or knew Bill, can relate to that. David Gordon, Alan Stockman, a former classmate of mine at Chicago, now passed away, was at the university for a long time. Russell Roberts, some of you may know. This is a good one. Russell played Alan Meltzer. He also played Maggie Thatcher. Some of you also probably know Peter Garber, also another classmate of mine at Chicago. Peter Garber played Arthur Burns. Harris Dallas was there. He played Ellis Tallman. Ellis is here too, right? You were in. Claudio, you were in it. And Robert Barrow were among all the people who participated in this musical. Now, the story portrays a dream that satirizes Karl's never-ending struggle to lead academics against the forces of evil. And the forces of evil were politicians, bureaucrats, and of course, the Federal Reserve. The dream talked about the role of the Shadow Open Market Committee, its role in instructing the Fed how to conduct policy. Yeah. It talked about the Carnegie-Rochester Conference to get academics interested in policy questions. It spoke about Karl's long friendships and collaboration with Alan, talked about Maggie Thatcher and Alan Walters. It was all good fun. We've all learned a great deal from Karl. I, for one, wish that one aspect of his dream was closer to reality. And that's the end of ad hocery in monetary policy making. Of course, those of you who knew Karl, ad hocery was Karl's way of describing discretionary policy. Unfortunately, discretion still rules in monetary policy making. And I think today it remains a serious problem for FOMC communications. It's very hard to talk about your monetary policy strategy when that strategy amounts to discretion. They're just incompatible. Karl worked tirelessly to improve intellectual discourse, economics, and public policy. He had a passion for encouraging younger scholars. And he also believed that academics can contribute in vital ways to improve public policy debates and sought ways to make that happen. Personally, I learned a great deal of economics, And I hope I absorbed a bit of Karl's wisdom he shared regarding public policy. So it really is right that we're here together today to remember a great scholar, but also a friend and a colleague. Thank you very much.
Well, thank you, Charles, so much for this brilliant presentation about dreams. I'm not asking you about your dreams. I see already that there are many hands going up. David, you had the first question.
Charles, I agree that we've got lots of evidence about the destabilizing properties of ad hoc monetary policy. And I agree that for Karl, the fundamental stability of the private sector was one of his articles of belief. I believe that phrase Tom Mayer took from Karl in describing monetarism a long time ago. And I also agree that if the private sector is fundamentally stable, rule-based monetary policy looks like it's going to work. And yet, if the private sector is fundamentally stable, does that mean that there is still a difficult question to be asked about just what kind of rule of monetary policy is going to prove robust? And doesn't that hinge upon what you said? We don't really know what happened in the early 30s. We don't really know what happened in the last 10 years. And just what is our evidence on the degree of inherent stability in the private sector? There's a big literature in the history of economic thought, not all of which is pie-in-the-sky Keynesian fine-tuning, but coming from people like Erich Lindahl and Friedrich von Hayek and all the rest of it in the 30s, that the stability in the private sector of the economy is an awfully fragile thing and can really be upset by what looks like very smart monetary policy. I'd like to get your reaction to that, because you've been on all sides of this through, you know, the most informative episode, whether you know it or not, in the history of economic thought.
I don't think there's not an easy answer for that, David, obviously. I mean, I think that one of the things that we tend to do is we tend to sort of try to make things black and white, sort of clear cut, so that we can understand them. I think that's an important part of what models do for us. They help us in our thinking to clarify and so that we understand certain things. Obviously, the world is not that clear cut. Models are just models. They're not reality necessarily. So other than just throwing up our hands and saying, we don't know, I think we do two types of things. One is, I actually tend to believe the private sector is mostly stable, not always, but it's hit by shocks and bad things happen and you can't do anything about that, or very little about it. So it's not either or. It's understanding that, in fact, during this crisis, a lot of the source of instability, I believe, was in fact not from the evil bankers that Ben was talking about, but was also part from stupid regulations. The fact that our tax code encourages leverage. Okay, if we think leverage is a bad thing, why do we leave in place a tax code that subsidizes leverage? Why do we have a bankruptcy code, for example, that tells short-term lenders, you get your money, if your counterparty goes bankrupt, you get your money back immediately because it's collateralized. You don't have to wait for it like everybody else does. So why do we subsidize short-term debt over long-term debt, which is what that does? Why do we discourage creditors from doing doing credit monitoring of their lenders, from their borrowers? So why did Fannie and Freddie hold 30% of all subprime debt that was bad on their balance sheet? Because Congress told them to do it. Okay, so there's this mixture of what bad policy does in setting the, quote, rules of the game, which is what we think governments should do. Well, sometimes they set bad rules, they get bad incentives from that behavior, and bad outcomes. then they blame it on the private sector without undoing the. So nothing's that clear cut, I think. So the way I think about it, and the way I think about monetary policy going forward, I believe in rules. I have for a long time. I spent much of my time at the Fed trying to sort of push doing rules. But I think what we have to do is think about not optimized rules of control plans, but robust rules. What robust rules have been considered? And there's an array of them. There are rules that have been investigated across very different models that have very different properties. So I think that what we have to do is accept the notion that we don't know it all, be a little more humble about what we think we can do, and look for those rules and mechanisms that provide stability and ease of communication to the public about what we're doing. And they exist. There are academics who have explored those robust rules. So it's possible, I think, to do that. It would ease not only, it would set correct sets of expectations for the public, and it would make communication, which the Fed has had a terrible time with communication over the last 10 years, as it tries to manipulate and do forward guidance. They could have solved that communication problem by announcing a robust rule. Because it wouldn't tell you what interest rates are going to be next year, but it would tell you something about how the Fed would decide what those interest rates would be. So I think the answer is looking for robust rules that do well, that provide good outcomes in models and across classes of models, and those things actually do exist. So I think having a little more humility and a little more focus on robustness and a little less detail in asking the Fed to go in and intervene in financial markets in every asset class it can think of for which it thinks the price isn't right, and fix it. But that's the way we've been conducting policy, I think, at least to a larger degree. I'm not sure that really answers your question, but I think it's the best we can hope for.
George, when you speak about rules, do you mean instrument or target rules?
Well, that's a whole different debate. I actually would prefer instrument rules because, in fact, and that's what most Taylor-type rules are. They're instrument rules. I don't think there's anything wrong with more outcome-based rules. Inflation targeting is not a bad thing. Inflation targeting is fine, except it doesn't tell you how to move the instrument. And if you have a lot of discretion to do things that you want, that discretion can become counterproductive to you achieving your ultimate target objective. So I think the target rules are incomplete, I guess is the way I would put it.
Alex? Yeah, microphone, please.
I completely agree with your characterization that you attribute to Karl about the importance of institutions. And I think in your answer just now, you actually gave several examples. And let me pick up on two of them. One is, the fact that Fannie Mae and Freddie Mac were holding such a large amount of those legacy assets. And the other one that Congress passed already a long time ago, the rule that allows people to deduct, mortgage payments for tax purposes. But this is not something that the Fed can handle.
Right.
In other words, one should remember that this is shared mostly by the fiscal authorities so it's Congress really. So it's not, so all the, we tend to sort of for the Fed for all sorts of things that really emanate. I think that the importance of institution, I think, is something that one has to take into consideration a lot. But I think that those institutions are forged mostly by the politicians, by Congress and by, and by the president and those that work out with the appointments. And in this context, I wanted to ask you a question about, and there is another one, by the way, which, there is this another feature that has to do with institutions that I think was important during the financial crisis, and that is the non-recourse. In other words, that, that an individual can come and basically, just leave the house and then, which is not the case in most other countries. And in this context, here's a question for you. Canada, just to the north of the United States, has had a lot of securitization, similar in magnitude in the real estate market as the United States, and it didn't have a crisis. So do you have any feel about what is the difference? And my feeling is that this has to do with institutions, difference in institutions. Could you say what your feeling after being in the Fed and all that, what are the different institutions that are responsible for this very striking difference between the outcomes in the United States and in Canada?
Okay, so let me make two points. One is, on the first part about who's responsible for some of these things, I think Alan made the point earlier that, the crisis and a lot of the trouble for the economy are real problems. They're not nominal problems, they're real problems. And that the Fed has a very hard time, expectations of having the Fed fix real economic problems. If the problems were bad regulations or regulations that distorted decision-making that led to the bad outcomes, it's not the Fed's response. Fed monetary policy can't fix that. So my big concern is that around the world, not just the United States, around the world, we've come to believe that monetary policy can fix almost anything. And the Fed and monetary policy makers have led the public, or let the public, accept that notion. They've bought into it because they were afraid to say, no, this is not my monetary policy problem. And they've been afraid to say that in the United States, partly because it's the dual mandate and you'll be afraid of saying you're abandoning your dual mandate. So I think that I'm really worried about the bar for expectations of monetary policy is way too high. And central bankers need to start saying that. We can't fix anything. Now, in the specific case of Canada,
live example of that just yesterday when Janet Yellen was talking on TV in the newspaper.
Yeah. So in terms of Canada, I think Canada is different in some ways. I mean, Canada really only has 5 banks. All right. So are the institutions different? Yes. Do I think that's the reason that they didn't have as big a crisis as the United States did? I don't know. Or is it because they encouraged lowering underwriting standards? They have very high underwriting standards in Canada. And I think Canada also has minimum loan-to-value ratios for mortgages and things like that. So there are just lots of differences that may attribute to that. So I guess I really don't have a good answer for in Canada's case, whether it was really securitization or what features of the institutions actually may have made the difference. Rarely is it only one thing. Usually it's lots of things.
We have time for one last question. Michael, please.
Yeah, I know a lot about Canada. I have done a lot of work on this, comparing the U.S. to Canada. The key difference was, it's very historical, was they've always had nationwide branch banking. And the U.S. had unit banking. Okay, that's first thing. Second thing, they had like one regulator, so they didn't have 20 different regulators. And that regulator had a lot of power. And the third thing is, the Canadian banks became universal banks, and they absorbed the mortgage banks. They absorbed investment banks. Everything was in one system, and it could be regulated. And the regulators basically put lots of limits on what they could do and the kinds of stuff that they can get involved in. That's what happened.
Thank you.
Okay. Thank you so much, Charles, for your presentation. Thank you.